Volatile markets can present lots of opportunity. But of course, what the novice trader doesn't take into account is that risk increases as these markets start to swing around a lot more. So I thought in this video, I'll take you through a couple of techniques I use for when markets get perhaps a bit wilder than we're normally used to. Hello, I'm David Jones from Capital.com. I thought it would be good timing to do a more educational video on looking at volatile markets. Clearly, we all know what's been happening across all sorts of markets since the middle of last week following the Russian invasion of Ukraine. And we've got to go back to at least the beginning of the coronavirus pandemic to see this sort of volatility. But actually, considering that it's happening everywhere, to me it feels more in common with what we saw back in the financial crisis 14, 15 years ago. So in this video, I'll go through some of the pitfalls of volatility and I'll go through also a couple of the techniques I've used and still use for trading volatility, ways we might want to try and profit from these bigger swings in markets, but while managing the risk at the same time. As usual, if you're watching this and you haven't subscribed, if you could click on subscribe, it does help support the channel. It means we can continue to push out lots of different content on the various markets that we cover throughout the week. And every Friday at 2:30 UK time, I do the live stream direct from YouTube. If you are subscribed with the alarm bell notification pushed, you get a message off YouTube just when we're about to go live. Right, let's get into it and take a look at these trading techniques in a bit more detail. So going back right to what I said at the beginning, market volatility can provide opportunity. But let's not forget, and I think people do forget this, the risk also gets increased dramatically as well. And I think, if you're a relatively new trader, you can look at market volatility and think that this is what trading is all about. But when you jump in, if you're not watching your risk, you could get taught a few expensive lessons. So FOMO, the fear of missing out. We talked about this a lot last year with some of the moves seen in tech stocks. This can be the enemy of many a trader when markets are volatile. Just look at what happened last Thursday, for example. So the early hours of the morning, we had the news breaking that Russia was starting to invade or attack Ukraine. We saw a massive leap in oil and gold, two most obvious markets to start moving. So the trader driven by FOMO, these markets are going to go to the roof, I need to get in, I'll worry about risk later. If they'd have stuck with that trade all day, as the day went on, these markets completely reversed and went back to where they were at the previous day's close. So I think, and I know, there are lots of people who were the wrong way around in the end on Thursday because of this FOMO attitude and not managing risk correctly. So I think just jumping in and hoping for the best, it might provide entertainment from a gambling point of view, but I don't think it's a sensible way of trading. Let's go to the other extreme. Doing nothing is always an option when we have markets swinging around like this. These are very much clearly news-driven markets at the moment, and what happens over the weekend or perhaps in thinner times of trade can really provide a shock to markets. If we look at where markets have started this week from Friday's close, oil and gold quite a bit higher again. Stock market started off lower, so you can get some real shock. So if you're not sure what to do, doing nothing is always an option. Don't think you've got to just jump in because markets are swinging around wildly, because chances are, if you are just jumping in, we're going back to that first point, FOMO, and you're probably going to regret it. So I think one way of trading, and I think it would have worked on Friday, I expect it to work in certain markets for the rest of the week, wait for the market to settle down. So wait for that initial sharp move in markets to settle, and then see, is there a sensible place to set a stop loss? So if the market's jumped sharply higher, let's see, do we get a pullback and do we get a sensible place to manage risk? I talked about this in the live stream at the end of last week. We were looking at both oil and gold that had pulled back to levels that it held well early in the week. If you were happy to take the risk on of holding these over the weekend, I wasn't, but there was a logical pullback trade to do there. The other thing we can do when we see markets react like this is what's known as fading the move. So this is definitely a more aggressive strategy, but it's taking the assumption the market has overreacted. So if the price of oil is drastically higher or stocks have been knocked back drastically lower, look at perhaps taking a counter trend position. I would wait again for the market to settle down. You don't want to be trying to, for example, sell short oil when it's racing away like it was on Thursday morning, when it got near to $100 before turning round in the cash market for West Texas crude. We've seen this strong bounce back in stock markets since Thursday afternoon when the US opened. So again, we want to wait for the market to calm down before initiating this trade to fade the move, because we have a sensible place for a stop loss. We're going to look at all of these examples on the charts in a minute. But risk control, one last point, is more important than ever when markets are moving like this. It's great to look back in hindsight and think, well, a week ago I could have bought oil at 90 and then it was trading at 100 on Thursday. What a great move that would have been. But I can almost guarantee you that markets moving like this, for most traders, will be difficult markets to trade and we'll see bigger losses than normal. So we need to just take a step back and continue to look at the markets in a sensible, disciplined way, and do not forget the risk control. Right, let's look at a couple of these techniques now. Let's jump onto the charts, take a look at some of these techniques, and have a look at some possible markets to watch as the week goes on. Let's start off just by reminding ourselves of some of the volatility this week and how hand in hand with volatility goes risk. So this is the price of crude oil. So this would have been coming into the early hours of Thursday morning. The market starts running away and we see the move starting around sort of from 2 in the morning as oil moves through 93, then runs all the way up. This is UK time, between 10 and 11, gets pretty near $100 a barrel. So yes, potential profit here, of course, if you jumped on it. But if you stayed in too long, the market turned round really quickly and went back to where it was pretty much at the start of the session. And you can see actually over the weekend, this is where the oil market closed last Friday night. US close, finished off the week around $91.40 a barrel, and then opens on Sunday night, because of course news has happened over the weekend, the market can't react, and then opens on Sunday at $98, but then has sold off since. So we can see how that volatility gives opportunity, but also dramatically increases the risk. Same thing in gold, just to illustrate the same time period again. So the price of gold starts moving again the early hours of Thursday morning, going from about 1,910, runs up again that 10 to 11 time slot to about 1,975, then really falls off a cliff as the day goes on, and actually by the evening of Thursday is trading below where it was at the start of the day. So another reminder that we really have to trade using stops and risk management. Going back to this idea of sitting on our hands, this is where FOMO, you can see the examples here in gold and oil, the fear of missing out can be really dangerous. So if we can be a bit more patient, and let's see how the market turns out. Eventually the market sells off on Thursday, trades down to about 1880, then comes back to that level later on the next day. So if we really wanted to be a buyer of gold, we've got a real level where the market's turned round. So we've got a pretty obvious reference point for our stop losses. Let's take a look at oil. So a similar setup on oil. I've taken it out to a longer term view here, but you can see, we've had this trend running in oil since the end of December last year, and the market sells off, but holds above the trend line. And if I zoom in, holds above, these recent lows we'd seen earlier in the week last week. So again, we have a definite reference point. Let's have a look at stock markets. So one last example, then we'll have a look at the idea of going against the initial move. So this is the NASDAQ 100. And again, early hours of the morning, it's a 24-hour market, the index. The market gets hit really heavily. So this is 2 o'clock and then 3 o'clock in the morning. Does trade a bit lower by about 7 a.m. But anybody who was just waking up and thinking, oh, actually, I'm going to sell the market here, needs to bear in mind how much it's moved overnight and think about, well, actually, is that already factored in? So once again, trading without a stop loss here would have been, and selling short, would have been a dangerous approach, because we know what happened on Thursday as US markets officially opened. We saw these losses and more clawed back, so if we're not sure where to set a stop loss, don't be worried about sitting on their hands. And now this idea of going against the initial move. The NASDAQ was a good example. I think oil and gold were both harder to trade going against that move because they turned so quickly. The NASDAQ, though, stock indices, took a bit more time to turn. So we'd seen the market fall off in the early hours of the morning, hits a low around just ahead of 13,000, early hours of the European session, then comes back to it in the afternoon, just ahead of the US session, and we have this strong candle up. So if you'd taken the view as US markets opened, well, hang on, perhaps we've seen the market overreacted. If you're a buyer, even after that first hour, you're a buyer at 13,350, you have a definite level to set your stop, probably the other side of 13,000. Now that's going to be a 350, 400 point stop, but the market is moving in much bigger swings than it is normally. So for me, if we're going to trade these volatile markets, then we have to use stop losses. And those stop losses have to be wider. We have to give the market time to prove us right. And then, of course, we know what happened next. The market moved higher. There was a similar trade, though, right at the start of the week. So US markets open as it's a 24-hour market. In my time zone in the UK, they start trading from 11 p.m. on a Sunday night. The market opened down here this Sunday. So opened the NASDAQ at 13,740. The market runs up. So again, let's just perhaps let things settle down, and then came back down in the early hours of the morning and didn't take out that previous low. So once again, we have a reference point. Well, if the market's overreacted, I'm going to be a buyer and my stop's going to go the other side of 13.7. So for me, recording this on Monday of this week, we still haven't had the official open yet in the US. We've still got about 90 minutes till that happens. But if we saw the market come under pressure today, let's watch that low set in the overnight session. So if we're going to fade the move, what we need to do is see how the market reacts and have a definite level to set our stop loss. And I think we had it last week in stock indices, because we saw a couple of shorter term supports come out, and we've had it so far overnight in the NASDAQ. So just think about markets perhaps a bit differently. If you get a somewhat large move caused by news, think, has the market overreacted? If I'm going to go against this move, where's my stop going to go? Where's my risk management going to go? If the market's really running away, don't feel you have to jump in and chase it. Sometimes you sit on your hands, wait for things to calm down. And if you're not sure at all, then don't do a trade. This is an incredibly volatile time we're going through. This volatility will pass and we'll get back to more normal markets in due course. So that's it for this slightly different video looking at how to trade volatility. Again, risk control, absolutely paramount. Doing nothing is definitely a sensible option if you're not comfortable with these sort of swings. We'll do further updates on markets throughout the week. But for now, from me, David Jones and Capital.com, we'll leave things there. Good luck with your trading. For more trading videos just like this, please subscribe to our channel.